All right. Hello, everybody. It's Mario from the Montesino Group. We specialize in commercial and residential loans. I'm going to go over some recently funded loans for some investment properties. So we'll dive right into it. So the first one is a fix and flip property. This is a single family residence in the city of Cerritos. So it's actually a beautiful neighborhood, gated community. This loan covered 87% loan to cost and 100% of the $250,000 rehab budget to fix up the property. So this property it's a good sized property. It's about over 3,000 square feet, cosmetic rehab. So hence the 250,000 rehab budget. It's a pretty good sized budget, but it is a larger home. This person put down 15%, and then we covered 100% of the 250 budget. 12-month term, no prepayment penalty. And we'll go over more details on this and the borrower and how we were able to help them out. Next one is your middle one. It's a 30-year fix, DSCR, no ratio. So DSCR is debt service coverage ratio. So the beautiful thing about these loans, and they're very popular, is because it does not require any tax returns, no W-2s, pay stubs, so no traditional income documentation, but you still get like a traditional 30-year fixed mortgage. Now, this property was a condo, and what's interesting about this is we were able to get a loan amount up to 75% of the value with it having no ratio. So that's very good leverage for not having like a one-to-one ratio. So typically on these types of loans, ideally, you have at least the rent covering the total payment, whether it's interest only or taxes or principal and interest. So this one, that's what's unique about this program, is that that ratio isn't quite there. Client was coming off of a hard money loan, and they needed to refinance into a long-term loan because they're going to hold on to the property. So it was a great solution for that client. And we'll go over a little bit more details on the next coming slides here as well. Last one over here. So I like this one because it shows what kind of leverage to expect if it's your first time. So this individual was buying a property in Chino, and it got referred over by another loan officer, actually a real estate agent. They're nearing the end of the escrow, and they're having issues with the traditional financing because there's some light health and safety issues. So that was a problem for traditional financing. So we quickly switched it over, offered a solution for a fix and flip loan. The client was going to fix up the property anyways. So they were having to put down 20% plus, and then also going to have to self-finance all of the rehab. So we put a loan in front of them. They were able to put 15% down off the purchase price and the rehab budget of $75,000. So then they were able to recoup it. So a lot better leverage, able to save the escrow in general because they were able to close quickly. So a couple of reasons why that was a good one. Let's go a little further over the case study. So this is the first one. This is the property in Cerritos, California. This is 87% loan to cost, and they bought the property for $1,710,000, and they're able to put 15% down, which is about $256,500. The property appraised the after repair value, the ARV, at $2,355,000. So they bought the property for 1.7, and it appraised at 2,355. They're going to have access to a $250,000 budget to rehab the property. So as they rehab the property, they're able to draw down on that. On there, and the total loan amount, sorry, you can't see it here, but I'll read it off to you. So the total loan amount on this was $1,703,500. I always like to stop there just to pause on the power of this type of financing and the leverage. So they bought the property for 1.710, right? And they're getting a total loan amount of almost 100% of that, right? You're at 1,703,500. So it's really, really good leverage. Out of that total loan amount, there's 250,000 of it that they're able to rehab the property. The property is about 3,050 square feet, and the initial loan amount was $1,453,500, and the total payment is $10,889. So this is off the initial loan amount. Remember too that rehab budgets, you don't pay interest on it up front. So as you start drawing down on that rehab budget, then your payment would go up accordingly. So some lenders will require you to pay interest on the whole total loan amount. In this type of program, which is a better way, it's interest on drawn. So as you draw down on that 250, then you would pay interest on it. So dive in deeper on like who that bar, like what that borrower, what was their profile. So they had a good credit score. They had a 745 credit score. I will note that most of these programs there's options as low as a 650 credit score. So pretty much 100, points lower. You could still get financing for that. You can go even lower than that and just leverage change. So down payment is higher, and then it becomes a little bit more costly to get that type of financing. But ideally, you're north of credit score 650. U.S. citizen, even though we don't necessarily need to be a U.S. citizen, but this borrower was a U.S. citizen. They were self-employed. Funds came from a business account, so they have a successful business and they had the liquidity to make the investment. They are a homeowner, and so not a first-time investor. So a big part of fix and flip financing, I will say, is track record, right? And typically we look at what's been bought and sold the last 3 years is like the heaviest weight when it comes to track record. This client, we're able to help out and get them a higher leverage, even though they hadn't bought and sold anything in the last 3 years. We're able to show the scheduled real estate properties that they own, and they rehab the existing properties. So they haven't sold them, but they're in their portfolio as rentals. So we're able to get creative and help build out that track record, which is very powerful when it comes to getting a higher leverage. So that was a big win there. Next one, we'll go over the debt service coverage scenario. So this is a 30-year fixed loan, and there's no tax returns or W-2s. The appraisal value came in at 491. The loan to value was 75%, so that tallied a loan amount of 368,250. The property market rents were 2195. The new mortgage payment with taxes and insurance was 3299. So that's a critical piece of this loan. Like typically, debt service coverage ratio, this would not work for a lot of lenders. And the loan was actually referred over by another loan partner that, there wasn't a solution for another 30-year fixed loan because the debt coverage wasn't there and the income documentation wasn't there. So currently the client was in a hard money loan the loan was coming to mature. So they needed to pay that loan off. And basically they're rolling into a nice 30-year fixed loan in this, and we were able to pull it off even though the ratio wasn't high, and the actual property type was a condo. So that was the details of that one. The client had a great credit score. They had a 755 credit score. They were a U.S. citizen. They had plenty of liquidity in their account. They were self-employed. They are a homeowner and not a first-time investor. One thing I would kind of note here, which is it kind of strikes me as interesting. So the client here is liquid, right? They have enough money to pay this loan off, but this client believes in leverage, right? And the ability to have their liquidity to make more investments. So it's interesting to see this, a client with this much liquidity that they could pay this loan off, no problem, chooses still to have a mortgage, right? So they can keep their liquidity to be in a position to buy more investment properties or, invest back in their businesses. So I thought that was a good note to when I was analyzing this property. Feel free, once again, this is Mario from the Montesino Group. Feel free to book a free call. If you guys have your own personal scenarios, I'd love to hear them. I'd love to see what you got going on. Been in business last 20 plus years. I'd love to hear from you and see what I can do to help out. Feel free to go ahead and book a call, and we'll talk on the next one. Have a good day.